Good morning, everyone, and welcome to today's webinar. I'm Alessio Fiore, research analyst at MDOTM, and today I'm excited to open up this conversation in which we will cover several hot topics in investing, asset management, and AI. Today with me, I have the pleasure to have Federico Mazzorin, which is MDOTM co-founder, co-CIO, and chief scientist, and Axel Maier, which is our head of global business development. So I also want to remember you that the webinar will last approximately 40 minutes, followed by a Q&A session. So please write down and submit your question, clicking on the Q&A button at the bottom of your screen. And so before we jump into the discussion, let's see what the webinar will be about. The webinar is taken from one of our most read papers, which is called 50 Shades of Alpha. And today we are going to cover several questions that are very, very important to investors and asset and investment managers. So we will start with background. So what alpha and beta means historically, what I've historically meant, and how our understanding of returns dynamic has changed through time. Then we will go deep and we will see how we exploit market inefficiencies, what they are, how they can be embedded into your investment strategies. And lastly, we will see an example of how we apply this technology into our investment strategies, analyzing the performance of our single stocks equity model, even in the last part of the year during the COVID crisis. And Federico will share some very precious insights of how we combine this technology to obtain more efficient and diversified portfolios. But first, I also want to let's take a step back and say what MDOTM does, how we do it, and what has led us to do what we do from about 5 years. We believe strongly that investing has become a tech challenge. And this means that, and we believe that in the recent years, internet has dramatically democratized the access to information, as it leveled up the information asymmetries between different market participants. So from this viewpoint, technology has emerged as the key to unlock value in investments and to catch the signal into the noise of the complex financial market. And for those reasons, we have chose to develop understandable AI that our clients, which are exclusively institutional investors, are actually able to control and understand. And what we combine in MDOTM, and which is the product of our growth, is that we combine innovation with the experience that we get from our clients and from the experienced market professionals that work with us. And this also has led our product range to be expanded and to feature different products. We offer portfolio diagnostics, which are actually scenario analysis that we conduct on a client's portfolio to underline and stress their strengths and weaknesses and how they are positioned. Then we have the asset allocation announcement, in which the client gets our research and our models as an input to its asset allocation, and the portfolio diagnostics. And lastly, we have our core business, which is the portfolio advisory, in which we develop and customize an investment strategies that uses our AI models on the preferences and the needs of our clients. And the strategies that we offer, you see in the bottom right corner, we have multi-asset, ESG, equity ESG, alternative, and also proprietary trading for institutional investors. So what actually is at the beginning of our journey is that we believe that AI is a tool and that everything begins with finance. This because AI is the best technology that we have today in order to extract value and to see the depth of data and to actually be able to adapt to the gradual unfolding of financial market. And this is well represented by this picture. At any given moment, we can imagine that a model can only grasp a part of the available information available on the market. So if we have traditional quant model on a side, which is the red circle that we see, and the green one, which is AI-driven models, when the market change, actually AI keeps on learning and keeps on adapting to the unfolding of financial markets, while traditional models are left stuck to what they have seen before. And this is not what investing is going to look like and what is investing now. And now I would like to leave the floor to Axel, which is going to introduce us to what alpha and beta mean, to how we have expanded our understanding of financial market dynamics in the latest 6 years. Axel?
Great. Thank you, Alessio. So I think we want to start with a definition so that we are all on the same level when we go through the rest of this presentation. We all know that, you know, the question or the quest for alpha has been going on for a long time, since at the end of the day, as a client, as an investor, the one thing you would like, you are usually willing to pay for is alpha. But you don't want to pay for anything where, say, it's a hidden beta. So, you know, we see that beta has come to systematic exposure to a risk factor that will happen anyway and doesn't take a lot of skills to do that. Whereas the idiosyncratic excess return of a security, and to find that on a regular basis, this is the skill of a portfolio manager or of a good AI model in our case. And so therefore we say that the beta is something that can be explained as a part of return, and the unexplainable part of return, the alpha, this is actually the skill that we look for. But how that skill was defined over time as an interesting journey. So, you know, in the 1950s and the time before, you know, modern benchmarks were defined, everything that happened was alpha. And then people understood the market has actually an impact, so that was taken out. Then we looked at size, value factors, alternative risk premium, etc. So to really find the part that defines the alpha and to use that properly, but also use the other components properly, I think this is something what's a big question today, and coming down to the value an asset manager can actually provide to their clients. And so what we try to do then today is to see how can we exploit these market efficiencies, and that's something Federico will let us know. Sorry, you are on mute, Federico.
Sorry. Yeah, this is a key concept. So inefficiency, it's opportunity. If you think about it, in order to be able to do better than the market, you must be better than the market, and you can't if the market is it's perfectly efficient. So all our research, it's focused on looking for market inefficiencies that we can exploit with our investment strategies. In order to exploit them, we have to develop investment strategies. At the core of this, there is the scientific method. This scientific method, it's based on experimentation. In this pharma example, you are sick, you take the drug, and you feel great. Of course, it's not enough to demonstrate that the drugs makes you feel better. In order to do that, you have to demonstrate the causality between the two events. And so all our research, it's focused on understanding why those inefficiencies exist and what can we do to enhance them in our strategies. There are a lot of different factors, a lot of different inefficiencies that are very well studied, very much used, and still they continue to exist. This is because of how the market is structured and because of behavioral finance and how decisions are made. Of course, all these inefficiencies are very weak, and it is not possible to exploit them directly. In order to do that, you have to analyze them, go at the very core of them, and develop a strategy that is capable of take the best of some of them.
Fede, sorry, but I would like also to add on top of what you have said before, that the scientific method actually allows us to see more clearly what are the drivers and how we can enhance what is just a raw anomaly and actually really benefit from them. Is that correct?
Yes, it's correct. For example, let's take the momentum effect. The momentum effect states that the stocks that overperform the market in the past year will overperform the market in the next period. This effect is caused by the fact that not everyone takes the same decision in the same times. There are investment committee, there are process, the funds needs to move. So an event in real markets has some inertia. So all the prices return has some kind of inertia that can be exploited. Of course, it's not enough to take the stocks that overperform the benchmark to beat the market, because this effect suffers some crashes in market stress that makes this effect not directly exploitable. There are two different approaches I'm going to describe in developing a strategy: the traditional quant and the AI-driven approach. In the goal of the traditional quant is to remove the biases and to enhance the systematicity of a strategy. Still, some biases continue to exist. In the traditional quant, you gather some data, you develop the strategy, and you maintain it. In developing the strategy, there are some biases in how you choose the strategy parameters and how you model your anomaly. The goal of the AI-driven approach is to reduce these biases and to enhance the adaptability of the strategy. And in order to do that, all this part of choosing the parameters and decide how to model the anomaly are made by a training process that can be controlled and can be done and redone in order to achieve the adaptability the strategy needs. Sorry?
So Fede, if we go back to the previous example that you underlined about the momentum effect, am I getting right? If a traditional quant model would be stuck with some parameters, so for example, the momentum, how we want to look back in time and how long is our holding period, and we have them fixed, while on the AI-driven approach, how would that bias be cancelled, eliminated?
Yeah, you described the parameters, which are, of course, a part of the strategy. There is also another main part, which is how you model the effect. For example, the momentum effect, it's not just how long you look at the past, how do you want to invest, but how do you get that effect. For example, the momentum effect exists because the inertia in prices returns. So you can look at how the past prices returns behave. If a stock is basically a random walk, which reacts very quick to the events. So the momentum effect for these stocks will be very weak, even if it overperforms the market. So there is the other part, how you understand if a stock is sensible to the momentum effect, which is a key part, and in which you make a lot of decisions in the modeling process. Another example could be how you, let's say you want to predict the volatility of a stock. A quant approach, it's, for example, the Garch model, in which you have the past returns, you have a utility function, you fit it, and then you have a prediction of the volatility. But in doing this, you made a lot of different assumptions. The AI-driven approach would be to firstly decide what is relevant to describe the future volatility. And then, for example, many different ways to measure the past volatility, the past returns, metrics compared to the benchmark, put it in the machine, and then let the machine find how they are valuable in order to describe the future volatility. In choosing doing this training process, of course, the goal it's not simply get the best results, but is to achieve a great stability. That's because we want that the model is capable of delivering what it's supposed to do. So, for example, in this chart, we can change the parameters. We can find the best spot, but it's not stable. It's not good, because if things change a little bit, then the model fails. So we run a lot of simulations, and we're changing the data, changing how we analyze those data, and the machine finds the solution that can achieve a greater stability. So maybe the result, it's not as high as the first one, but it's more reliable, and that's what we are looking for, of course.
So actually, just to wrap up all the insights that you have provided, using AI plus the scientific method actually is able to achieve control over the anomaly, the inefficiency that we spot. So actually makes us able to actually deliver what the factor is and make it investable. So create a more efficient and diversified portfolio in this case, and to fully exploit the market dynamics that we have considered using this kind of approach. Is that correct?
Yes, that's correct.
Okay, and so I think that another important question that arises from all of that we have said before. So what alpha and beta is, how we use the scientific method, how AI can add on top of all of this extra layer of value and understanding. So another question that we naturally have to ask is, where is hidden the alpha of tomorrow? And most importantly, is still available alpha on the market, or as Axel, as you have said before, we have discovered a lot of factors, but alpha has not yet disappeared. What is your opinion on that?
I think we all hope that alpha hasn't disappeared. It's just more difficult to find. And I think to connect from the theoretical background that Federico just gave us, where we say the AI helps to provide investment outcomes that are in line with what clients expect that would happen to their portfolio. I think that's the critical part to be able, and this is where the alpha comes in and plays an important role, but also the understanding what factor performance means, to make sure there's the predictability, which gives clients a much higher level of planning stability with their finances. And I think that's very crucial. And so I think we all have seen this kind of chart, how certain factors have developed in the last 18 years or so. And the key point is that there have been phases where, let's say, value was doing well over many years, but then it dropped down. And that's kind of a constant across all these factors. There's not one factor that always was a good choice. And so it's, you would argue it's coming down. If you find somebody who's able to pick the right factors all the time, would be a good job. But I think this is where we want to take this any further and say, is factor return really the only thing that should drive performance, or is there more that can be done with it through the use of artificial intelligence? I think that's what Federico can answer, and may use an example of what we have done in Europe to see, what role factors actually play in defining alpha in the future. Federico, do you want to elaborate on that?
Yes, of course. This is the performance of our single stocks model, which is a bottom-up approach. With a bottom-up approach, it begins from a basket. In this strategy, it's applied on the European stocks, and whose goal is to achieve better diversification and lower volatility, while keeping the upside of the equity market. So this is the goal. The strategy, it's live from the mid of 2017, and this chart is updated to the end of June. As you can see, we actually overperformed the market, and the strategy did what it's supposed to do. So on average, it had a volatility of 70% of the benchmark, and was capable of reducing the drawdown of the benchmark. As you can see, there is an alpha component in the strategy. It's on average between 2 and 3%. In this period, it was 2.5%, and but a good portion of the overperformance was driven by the factor exposure of this strategy. In fact, this when we developed this model, we choose to exploit the inertia in market condition in order to achieve this greater efficiency. And though you can see that we have a different factor exposure in different times. This is crucial to understand, because we need to understand what are the risk premia the strategy it's going to exploit when doing the performance.
Well, also in this case, I want to add a little bit on that, saying that what you said is very, very important in the sense that when we develop a model, when we develop an investment strategy, we have different constraints, different objectives. As you've said, these strategies, the objective of being highly correlated with the market, reduce the drawdown, control the volatility, and be more efficient. So actually have, even in periods of stress, as we can see from the plot here, it's something that actually gives value to what you said before. So to have control on the market anomaly, so the two components alpha and beta, and so as also Axel have said before, to just combine factor and add an extra layer on top of that. Even if we want to see how the model reacted to the most recent COVID crisis. Fede, you want to expand a little bit more on that, on how we managed volatility and drawdowns during this period?
Yeah, yes, of course. Yes, during this recent crisis, the model performed actually as it is supposed to do. After the first months of good performance of the market, that was the great crash due to coronavirus, and the model was capable of reducing the drawdown somehow. So even if we did not overperform the market in the recovery period, we performed roughly the same as the benchmark. We were capable of gaining a delta over the benchmark. This is because how the model is structured. The model it systematically reduces the fluctuation. So let's make an example. If you lose 50% and you do plus 50%, you are down 25%. If you lose 10% and you make 10%, you are minus 1%. So the model does this systematically. And
the most important rule in investing.
Yeah, most important rule in investing, it's the drawdown trap. It avoids the small drawdown trap in a very systematically way, while gaining some alpha over the benchmark and using factors to achieve its results.
And also to the same point that during this period we delivered an alpha of about 5%, as we can notice here, which is actually something of really great value during this time. And for just jumping into summing up what we've said, I hope that we have shared some thoughts about how we see all those pieces fit together in applied investment perspective. We can just sum it up in 4 things that I think, and we all think that are pretty important. The first one is that to deliver a consistent and persistent alpha, a traditional approach is just not enough, and we need to just bring it to the next level and bring it a step further, as we have seen. So just traditional multi-factor is not going to deliver the alpha that we expect. And this is really connected to where investment factors come from, in the sense that investment factors are a source of information about the structural and behavioral dynamics of financial market. But then it is up to us to catch that information and embed into a profitable and efficient investment strategy. And this is why factor analysis, factor investing, and all this universe, which is connected to the application of AI to the modern approach of portfolio management, is essential to understand why we perform, why we take some risks, and also why there are some risks that are rewarded in a good way and others that don't. So taking diversification under control and a tight risk management are actually the ingredients of a profitable investment strategy. And this is, I think, what we can gain from all of that discussion, and especially how AI is adding an extra layer and is actually changing and reshaping how the approach of portfolio management is going to look like. So I also now want to open the Q&A part of the webinar. I'm seeing that there are lots of you that are connected, and also lots of you which are posting your question. The first question that I have is probably for Axel. I have this question, Axel. With factors, has become more easily to do money on the financial markets? I think that it's a good question to start on.
So, okay, so the question is, which factors have been easier to make money on?
No, the question is if having discovered investment factors make more easy to make money with investment strategy. So if I invest on a single factor strategy, am I going to become rich sooner or not? So
I think that there's no no sustainable way of getting rich quickly through investing. No, I mean, I think that's the point, that certain single factors have not consistently performed well, and we have seen that in that chart. And I think that the point we want to make here is also that just using factors as the pure provider of a decision is the wrong way to go. In our case, they provide us information of how to build the model, but it's not the driver of a decision. And I think this is, if we think about tomorrow's alpha, that factors as such are maybe just information providers and not investment targets anymore.
Clear. And just to elaborate on that, it's the fact that you have said before that factors are cyclical. So actually, there is no straight line to become rich with factors. And on top of that, I have also coming another question, which is the following one. Fede or Axel, I think that Fede is the most appropriate one to answer that. The question is, does the model pick factors and then select the stocks, or factors are only a source of information that our model uses to determine the portfolio?
Yes, it's the second one. The strategy uses a bottom-up approach. So from the single stocks, you analyze his performance, his sensitivity to different factors, and then it builds in the portfolio. We choose this approach for a simple reason. The markets are quite noisy. The factors are very noisy. So working with single stocks, directly with single stocks, allow us to have greater numbers, and so greater statistical significance. And so it's simply better for us to work with that. Working with just the factors and then build the portfolio from that may appear a little bit easier, but in practice it's less effective for us because of the statistical significance. Less things to work in means less data, and so less statistics.
Clear. And again, another question, which is actually really interesting, and is this the following? Is there still hope to find the alpha? And so we have seen until now that alpha is actually reduced dramatically in size. So in the 50s, we thought that everything was alpha. Now we know that alpha is only a fraction on that. But is it that at the end, alpha is going to take different shapes in how we are going to deliver alpha, and which is the mechanisms that drive that?
I think that the perspective it's different. It's not that if in the earlier century you don't know about the market, then the market factor does not exist. It's the knowledge and the understanding of the factors that is increased. But so it's not that the alpha itself it's diminished in this period. It's the perception of it that it has.
Clear. And also
add something to that. It's also that I do think is that on one hand, as Federico said initially, the efficiency in the market is reasonably high, but it's still not perfectly efficient. And there's of course not 100% foresight. And what AI cannot do, and Alessio mentioned at the beginning, it's not the crystal ball, it's a tool. And it's, and you can have seen some of the results on our side. If you use the tool wisely, you can actually exploit this efficiency and generate some alpha, but there's still uncertainty there. And so this is, as long as there's uncertainty, there's alpha.
Clear. And I think this is actually a precious insight from that. And also, which is the subsequent thought that I think that follows that conclusion, is that to a certain extent, alpha has become the ability of moving between the different betas and combine the twofold approach that we have seen until now. And I think that this is quite reflected in how the R&D, research and development, works at MDOTM. Fede, if you want to just expand a little bit on that and how we research, since it's another question that I'm receiving right now, how R&D works in MDOTM, how we identify, develop, and deploy our investment strategies.
Yeah, okay. So, of course, developing a strategy, it's a very, very long process that comes in different steps. At the beginning, we choose which anomaly we want to exploit. So and we begin doing this research on known sources, on what it's known about that anomaly, what are its weaknesses and its strength, when it works, when it's not, and why. All this process, it's made with the help of the universities, with thesis studies, thesis guys, and the goal, it's not to develop an investable strategy. It's to understand everything it is known, and which edge we can use to enhance them. When we found that edges, then the core team comes in and does more studies on that, and learns how we can do better than the market. I think we can enhance the strategy. The next step, it's about AI. Once we understood what we can do, then the goal is to do it in an unbiased way and with the adaptability only the AI can offer. The very last step is
the right tool in the right place to add an incremental benefit on that.
Yes, that's correct. And the very, very last step is to close and close everything and have a product that can be sold. So there are some marketing issues. Okay, everything good, but how can we invest it? How can which products are good for it, and so on.
Clear. And on that, I have also following another question, which I think Axel can start, and then Fede can go through and take a deep dive on that, which is it's twofold, the question. The first one is what type of data our model uses in general, what is the information that we take into consideration in our model, and then Fede, there's another one which asks how the training and the learning of the machine actually is conducted and how it adds value to the investment strategy.
Okay, so I think that it's a very good question. And so I think that for us in general, the overarching philosophy is we try to keep things simple wherever possible and make it complex where it's necessary. And so, and then Fede will be able to talk more about what led to these conclusions, but we do use only price data for our models. And this is not out of laziness or anything like that, since it turned out this is the best available data, since it's clean, it's undisputable, it's available in great quantity, and it's unbiased, So these are almost like the four key things you need to have to get good data. Since at the end of the day, the old saying of garbage in, garbage out is also true for AI. And so this is why we use just price data and keep that very simple. This is for clients, easy to understand. There's no debate. If you want to know what the price of General Motors was yesterday at 10 o'clock in the morning at the New York Stock Exchange, there's no debate about it. That's very clear. And this is why we use simple price data that provides the best results. And that's, again, it's a result of a lot of work that has been done in the R&D department to make sure that's the case.
Yeah, that's really correct. That's why we use that data. For us, having a great quantity of data, of the same type and undisputable, it's crucial. And we believe that the information is there. So we starting from that, we can develop a model that can be adaptable and understandable. Because if you think about it, you can use tweets, but a strategy that uses that kind of data, it's quite hard to understand its behavior, for the simple fact that this kind of data evolves in time, are quite recent, and so there is less control on the output, and the control, it's quite important in order to be able to deliver what you are saying to deliver.
And I also think that this additionally stress out what Axel and you, Fede, said, that the scientific method relies on quality, unbiasedness, the fact that we have robust evidence that supports a hypothesis. So actually the triangle between those three components is essential to build something that is understandable, something that is reliable from our customers' point of view, and also, and this is the important part, which is something profitable. Is that correct, Axel?
Yeah, I think that was a good, that's a good summary. I think, yes, that's true. Yeah.
Okay, so I see that we are starting to reach the end of our discussion. I hope that you all have listened to it and have had some insights to elaborate on and to think about, and we will be happy to answer your additional questions by email if you write down to ask@m.m.eu. You will receive the slides at the end of this presentation by email, and our contacts are name.surname@m.m.eu for additional questions. And I also, Axel, would like to just recap what we offer to our clients.
Sure. At the end of the day, we have to show you how we make a living, I guess. But very, to summarize, there are three things. One is a portfolio diagnostic, where we basically look at any kind of portfolio that a client is currently running, and stress tested using the AI for possible scenarios, and basically can tell a client whether the portfolio will react as the client thought it will in any kind of possible circumstances, and we can make suggestions to how to rebalance that. We do provide an asset allocation enhancement where we receive bespoke guidelines and restrictions from a client and provide the asset allocation on a sector level or regional level, but also help with a lot of workshops in the way how the investment committees can use that. And then, last but not least, and this is our core business, is that we basically provide asset management services with the exception of doing the implementation. So we run a portfolio for clients. The clients will receive on a regular basis the changes to holdings, and clients would then execute these holdings. So that this is also where the control comes in, that if clients feel uncomfortable with something, we can of course explain that, but also the last say would have the client in the implementation. So that's almost like a little bit for everything. If you want to get just a teaser of portfolio diagnostics, if you want to go all in, that would be portfolio advisory. But as Alessio said, we are happy to take this any further. If you would like to, please contact us. And otherwise, I hope you you enjoyed that webinar and that you will have a very nice weekend ahead of you.
I agree.
Yeah.
So coming to the end, I'll say goodbye to all of you. Thank you for listening, and also tune in for our next webinars. We are going to take more load of those to expand on our insights that we regularly publish on our newsletter, The Edge. So we are going to cover in the next few webinars other topics such as topic of behavioral finance, diversification, how we can enhance portfolio efficiency, what not to do in portfolio optimization, not fall in the trap of good-looking ideas that actually do not deliver performance. So tune in and remain for our upcoming webinars, and subscribe to our newsletter, and have a good weekend to you all. Bye.